Imagine this, right? You secure a massive multi-million-dollar contract to build out the green infrastructure of the future.
Oh, the absolute dream scenario for any of these companies.
Right. You're ready to break ground. Your supply chain is totally primed. And then, literally overnight, you realize the government incentives funding your customer's entire project might just vanish.
Yeah, and just like that, the capital expenditure freezes.
Exactly. The whole project stalls. And that is the exact tightrope that infrastructure companies are walking right now.
It makes for honestly one of the most compelling business narratives out there, the corporate turnaround.
Oh, totally. Because it's a completely different skill set than, say, managing a legacy tech monopoly.
Oh, completely different.
I mean, stepping into a company where the fundamentals are just cracking, stabilizing that balance sheet, and somehow charting a course back to profitable growth, it requires this really ruthless operational discipline. You're dealing with physical inventory, super volatile raw materials, and incredibly complex enterprise sales cycles. Which brings us to today's deep dive. We are looking at a masterclass on those exact mechanics. We are decoding a single, highly detailed source today. The Q4 and full fiscal year 2026 financial report from Orion Energy Systems.
Ticker symbol OESX for anyone following along.
Yep, OESX. This report dropped on June 4, 2026. And if you aren't familiar with Orion, they operate deep in the commercial green infrastructure space. We are talking about designing and installing energy-efficient LED lighting arrays, rolling out electric vehicle charging stations.
And crucially, providing the long-term maintenance to keep all those systems actually online.
Right, which we will definitely get into. So the mission for this deep dive is to really move past the raw data and examine CEO Sally Washlow's first full year at the helm. We want to dissect the anatomy of this turnaround.
Because when a company's trying to pull out of a financial dive, those quarterly reports can be incredibly noisy.
Oh, yeah. Lots of weird accounting stuff going on.
Exactly. You really have to strip away the, one-time accounting adjustments to see if the core operational engine is actually generating sustainable cash flow again.
So to understand if Washlow's strategy is actually taking hold, you first have to look at the top-line revenue, right? Like, have they stopped the bleeding?
That's step one, always.
And based on the fiscal year 26 highlights, I mean, the momentum is undeniable. Total revenue for the year hit $86.3 million. That's an 8% increase from the previous year.
Which is a solid recovery signal.
Yeah, and the fourth quarter, specifically Q4, saw this massive spike. Revenue hit $25.7 million, which is a 23% jump compared to Q4 of the prior year.
Wow. But, while revenue growth is a really strong indicator, in a turnaround situation, top-line growth means absolutely nothing if your costs are just scaling at the exact same rate.
Right. If you're making more but spending more, you're still sinking.
Exactly. The metric that dictates actual survival is your gross margin. And Orion's Q4 gross margins jumped by 950 basis points year over year. They landed at 37.0%.
I mean, a 9.5% pure margin expansion in a single year is massive.
It's huge.
Think about it like, okay, think about a high-volume commercial kitchen, right? One that supplies regional grocery stores. Say they do $10 million in revenue. Then suddenly, they overhaul their entire operation.
Okay, I like this.
They renegotiate long-term raw material contracts directly with the farms, cutting out the middlemen. And they completely retool their assembly line to, eliminate waste.
Right.
They don't raise the price of their product, and they don't lower the quality of the food. But suddenly, just because of those internal efficiencies, they were keeping almost 10% more pure cash on every single pallet that leaves the loading dock.
That is a great analogy. And the term Orion actually uses for their version of that kitchen overhaul is a structural reset.
Structural reset, I like that.
Yeah, and achieving a consistent margin over 30%, which, by the way, they did in every single quarter of fiscal year 26, is a historical first for them.
Wow, really?
Every
quarter.
Yep. And it requires three distinct levers. First is pricing power, meaning they successfully defended or even raised their prices against competitors.
Okay, so they didn't just slash prices to win bids.
Right. Second is extracting cost improvements across their supply chain. Aggressively managing what they pay for raw materials like aluminum and electronics.
Which is not easy right now.
Not at all. And then the third lever is strict, disciplined internal cost containment. Washlow attributes this directly to building what she calls a resilient and adaptable proprietary supply chain. It's really about not being at the mercy of the spot market for your components.
Okay, I hear the enthusiasm for the structural reset, and it sounds great, but let's just pause and look for the asterisk.
Always a good idea.
Because a 37.0% gross margin in a heavy infrastructure quarter almost sounds, I don't know, too good to be true. When you dig into the footnotes of this report, does that Q4 margin actually hold up under scrutiny?
You're right to ask, and the footnotes do reveal a pretty significant caveat.
I knew it. What is it?
Well, the report shows that $1.3 million of that Q4 revenue was generated by amending a legacy solar energy contract. And the critical detail here is that this specific $1.3 million carried absolutely zero cost of goods sold.
Wait, so it was just like an amendment fee or a retroactive pricing adjustment that dropped $1.3 million of pure 100% margin cash straight to the bottom line?
Yes, exactly.
Okay, well, that definitely changes the math.
It does. It artificially inflated that 37.0% Q4 margin. Now, I mean, it is real cash, which is vital for bolstering the balance sheet during a turnaround. You need that cash.
Sure, cash is cash.
But you cannot model future quarters assuming you're just going to stumble into zero cost revenue over and over.
Right, you can't bank on a lucky break every quarter.
Exactly. However, if you strip that anomaly out completely, the core operational profitability is actually still vastly improved. We see this in their adjusted EBITDA.
Earnings before interest, taxes, depreciation, and amortization.
You got it.
That is the real pulse of the business.
It really is. And they secured their sixth consecutive quarter of positive adjusted EBITDA, hitting $0.8 million in Q4. For the full year, they ended at $2.2 million.
Okay, and what was it the year before?
Contrast that with the previous year, where they suffered a nearly $3 million loss in adjusted EBITDA.
Oh, wow.
Yeah. Washlow basically engineered a $5.1 million swing in core cash generation.
Okay, so the patient is stabilized, the structural reset is holding, even without the magic, $1.3 million.
Yeah.
So if you're looking at your own portfolio right now, or you're just analyzing how modern industrial sales work, you have to look under the hood at the actual revenue engines, like which specific segments are funding this recovery.
Well, the primary engine is definitely their legacy business, the LED lighting segment. This involves retrofitting sprawling commercial and industrial facilities with these massive high-efficiency lighting arrays.
And the numbers here are explosive. Q4 revenue for LED lighting surged 86% year over year. It hit $20.3 million.
Which is what?
Yeah, and full-year revenue hit $55.9 million. But just to be clear, this isn't about selling millions of individual light bulbs to consumers, right?
Oh, no. They are hunting big game.
Right. The report highlights a $21 million electrical contracting array spread across just 7 customers.
Yeah, which averages out to like $3 million per deployment. They also secure a $3.6 million engagement for an international lab-based testing company and a $3 million project for a leading food service enterprise.
Those are massive deals.
They are. And when corporate customers are signing $3 million work orders for lighting, it's driven by the immediate return on investment. I mean, upgrading an entire distribution center to advanced LED arrays slashes the facility's ongoing operational energy costs so much that it heavily subsidizes the actual capital expense of the installation.
It pays for itself.
Exactly. And Washlow noted that these deployments are becoming, quote, bigger and more numerous, which really signals that their relationships with these massive enterprise clients are deepening.
It's that classic enterprise land and expand strategy. You win the bid for one regional distribution center, you prove the ROI, and suddenly you're retrofitting their entire national footprint.
Precisely.
But let's look at the second revenue segment, maintenance services. Because honestly, this really feels like the unglamorous anchor of the entire turnaround.
Oh, completely.
Maintenance generated $16 million for the year.
Yeah.
So it doesn't have the flashy 86% growth of the LED wing, but it provides the recurring revenue that smooths out the financial volatility of those massive, lumpy enterprise sales we just talked about.
And recurring revenue is the absolute bedrock of corporate stability. The report actually details this staggering multi-year renewal they secured for preventative maintenance across 2,050 big-box retail outlets.
2,000, wow.
Yeah, that contract is valued between $42 and $45 million over 3 years.
So they have guaranteed millions flowing in every single quarter just to ensure the lights stay on, the ballasts are swapped, and the wiring is secure across a couple thousand retail stores.
Exactly. And securing that trust unlocks even further project revenue. Because they already own the ongoing maintenance relationship, that exact same big box customer awarded them an additional $14 to $15 million contract specifically for exterior lighting work.
Oh, that's brilliant.
It's the perfect ecosystem. The maintenance teams are essentially embedded sales reps, right? They're identifying upgrade opportunities while performing routine service.
That cross-pollination is exactly how a struggling company rebuilds its balance sheet. But, I mean, a true corporate turnaround always has weak points.
It's never flawless.
No, we need to examine the segments that are actively dragging down these averages to see where Orion actually remains vulnerable.
And that requires looking at their third segment, electric vehicle charging solutions.
Right. This is the glaring red flag in the Q4 data.
Ah.
EV charging revenue plummeted 61% down to just $2.3 million.
Yeah, that's a tough drop.
And for the full year, the segment dropped 15%. So if you are watching the green tech space right now, you really have to wonder, is this a localized failure by Orion's sales team? Or is this early evidence of a massive macroeconomic bubble bursting in the EV infrastructure market?
Well, the report leans heavily toward macroeconomic headwinds. Orion points to, quote, variability in timing of larger projects and current uncertainty around the near-term scope, pace, and funding availability.
Which translates to their customers want to build the charging stations, but no one is exactly sure who is actually writing the check.
Precisely. To really understand the mechanics of this, you have to read the safe harbor statement, the mandatory risk disclosures in the report.
Always read the fine print.
Right. Orion explicitly warns investors about the risk of the United States government reducing or even eliminating EV infrastructure incentives. The reality of B2B infrastructure is that massive corporate or municipal customers rarely fund these EV buildouts entirely from their own capital budgets.
Because it's just too expensive.
Way too expensive. They rely heavily on federal and state subsidies to make the math work. So if a government grant program pauses, or if the political landscape shifts and creates uncertainty about future funding, the customer immediately freezes the project.
So the demand for the physical charger is entirely tethered to the availability of the subsidy.
100%.
That makes the 61% plunge make total sense. It's just a capital expenditure freeze.
Exactly.
But the source material also indicates Orion isn't just, abandoning their green tech ambitions. They are still actively fighting for complex, forward-looking deployments.
Oh, they definitely are. The report highlights a $4 million project to install 105 EV stations for the Boston Public School.
That's a solid win.
And they also point to a highly complex $10 million array of 80 stations stretching across multiple states, going from the Northeast all the way to California. Executing a multi-state deployment like that means navigating dozens of different municipal codes, permit structures, and local utility grids. So it proves they still have significant operational capability in this space, even if the revenue is down right now.
I also noticed they are attempting to diversify the segment by rolling out an on-site battery storage system geared toward industrial and commercial sectors.
Yes.
They are currently deploying this system across 10 locations in California. It feels like a very strategic pivot. Like, if the market for the actual car chargers is stalling, selling the battery storage systems allows their commercial clients to store cheap energy during off-peak hours and rely on the batteries during peak pricing times.
It's right. It acts as a necessary hedge. But whether they are selling batteries, LED arrays, or EV chargers, a turnaround ultimately lives or dies based on internal operations.
Absolutely.
You can win a $20 million contract, but if your internal cost structure is bloated or your back office is just a disorganized mess, that revenue will bleed out before it ever hits the bottom line.
So let's examine how Washlow approached the internal plumbing of the company. How much fat did they actually manage to trim?
Well, total operating expenses were pulled down to $29.7 million for the full year. That reflects some pretty aggressive cuts to infrastructure and personnel overhead.
Okay.
However, the Q4 ledger is packed with what analysts call noise. Basically financial house cleaning. It makes the current quarter look really messy on paper, but it is structurally vital for long-term survival.
Give me an example.
First, they executed a $1.7 million final earnout payment for Voltrek.
Voltrek was the EV charging company they acquired a while back, right?
Exactly. So this means they finally settled that legacy debt from the acquisition, and that liability is officially off the books moving forward.
Okay, clean slate there. What else?
Next, they took a $1.1 million non-cash write-off of solar assets. They essentially audited the value of their existing solar equipment, recognized it was overvalued on the balance sheet, and adjusted the value down.
So it takes a hit on the accounting ledger, but it doesn't actually drain $1.1 million from their operating cash.
Spot on. And then the final piece of the house cleaning, a $0.6 million loss on debt extinguishment.
Debt extinguishment, that sounds painful.
They incurred a financial penalty to fundamentally restructure their debt. But the strategic trade-off there is massive. They successfully extended the maturity date of their revolving credit line all the way out to 2030.
Oh, wow. In a turnaround scenario, time is oxygen.
It really is.
By pushing their credit deadlines out to the end of the decade, the bank isn't breathing down their neck while they try to execute their strategy.
Exactly. Combine that with the recent public offering that injected $6.4 million in fresh cash, and the balance sheet suddenly looks highly defensible.
So the old M&A debts are settled, the credit line is extended, and they have liquidity.
Yep. Which naturally shifts the focus to fiscal year 2027.
And CEO Sally Washlow is projecting immense confidence for 27. The forward-looking guidance targets between $95 million and $97 million in revenue.
Which represents a 12% jump over the year we just analyzed.
A 12% jump. They expect continued positive adjusted EBITDA, and they are entering the year heavily armed with a $30 million backlog of signed projects. That backlog alone grew by $13 million over the previous year.
That's a huge cushion to start the year with.
Right. Washlow states in the report, quote, growth, increasing profitability, and continued market expansion are expected themes for FY27, as I've said before. I expect it, our team expects it, and our shareholders expect it.
That level of executive confidence is honestly required in a turnaround. But, we have to ground it against the explicit risks detailed in their safe harbor statement.
Bring us back down to earth.
The fundamental vulnerability of Orion's business model remains their lack of diverse recurring revenue. We praised the massive retail maintenance contract earlier.
Right, the 2050 stores.
Yeah, but broadly speaking, this company lives and dies by a hyper-competitive bidding process. They have to constantly hunt for and win these multi-million-dollar one-off retrofit projects.
And they are defending those bids against foreign competitors who are systematically driving down the average selling prices of the hardware.
Exactly.
Orion is trying to protect that hard-won 37% gross margin while simultaneously fighting off international manufacturers who are totally willing to undercut them just to capture market share.
Furthermore, they remain highly exposed to supply chain friction. If a new wave of international tariffs hits the specific aluminum or electronic components required for their proprietary LED arrays, those cost improvements they engineered, they could evaporate overnight.
Just gone. And there's also one internal operational risk that stands out as a potential nightmare scenario.
Oh, the ERP system.
Yes, they're in the process of implementing a new ERP system, an enterprise resource planning system.
An ERP is essentially the central nervous system of a manufacturing and logistics company. It governs everything: warehouse inventory, raw material procurement, order routing, financial invoicing, all of it.
And the safe harbor statement literally warns that this implementation brings, quote, substantial cost and potential disruption to our normal operations.
Yeah, that's not a boilerplate warning.
No, if the deployment fails or the data routing logic glitches, it can freeze the entire business. You could have a warehouse fully stocked with LED arrays that you cannot physically ship because the software won't generate the routing slips or process the invoices.
It happens all the time. Undergoing massive software brain surgery during a fragile turnaround is an incredibly high-stakes maneuver.
It's necessary for long-term scalability, sure, but the short-term disruption could easily jeopardize that aggressive FY27 revenue guidance if it's not managed flawlessly.
Totally.
So if we pull all of these threads together, the Q4 2026 report paints a really vivid picture of a company that has successfully stopped the freefall. Under Washlow's leadership, Orion Energy Systems has utilized a massive surge in enterprise LED contracts, plus the quiet, steady cash flow of retail maintenance to fund a comprehensive structural reset.
They achieved historic gross margins, systematically cleaned the legacy debt off their balance sheet, and secured their credit lines, all while absorbing a brutal 61% contraction in their EV charging segment due to shifting government subsidy environments.
It is basically a textbook example of leveraging your profitable core business to survive the macroeconomic storms hitting your experimental growth sectors.
It really is. Analyzing Orion's recovery highlights a much larger dynamic at play in the whole green infrastructure transition.
Oh, so.
Well, we've focused so heavily on the financial hurdles of manufacturing and selling thousands of EV chargers and massive commercial battery arrays.
Right.
But if these infrastructure pioneers are actually successful, like if they deploy this technology at the scale projected over the next decade, it raises an entirely different structural question.
Okay, what's that?
As these hydro installations come online across schools, commercial hubs, and retail centers, does our aging local transmission grid even have the capacity to handle the load?
Oh, wow. That's a terrifying thought.
Right. Or will companies like Orion eventually find that just selling the hardware isn't enough, and they actually must pivot into localized microgrid power generation just to ensure their own installations have enough electricity to even function?
That is a fascinating systemic risk to consider. The bottleneck might shift entirely from corporate funding to literally just raw electrical transmission.
Exactly.
It's definitely something to keep an eye on as you watch these infrastructure deployments roll out in your own cities. Well, that's all the time we have for today's deep dive into the mechanics of the Orion turnaround. We will catch you on the next one.